Now, this might be one of the most hated bull markets we have ever seen. We literally have record money in money markets, and now all of a sudden, smart money is starting to take profits and looking to short this market as of late of April. There's a few commonalities I really want to point out when we see top of markets starting to form here. Normally, the breadth is very narrow. It's usually a hated bull market. And by the time that smart money starts selling and dumb money's dumping in, that's when we see a big reversal in stock performance. Now, I'm not saying we're doing this anytime soon, but I just wanted to bring this to your attention because of the separation when we look at the S&P 500 to the equal weighted S&P 500 to the Russell 2000. It's definitely been a wide disparity and clearly a narrow breadth. Now, while this bull market's been going on, 40% of the Russell 2000 is actually still unprofitable, and this high interest rate market is definitely making them fail. We're watching a tremendous amount of companies fail and actually go under. So while markets are hitting fresh new highs, we have iconic brands like Nike selling off, Disney, Stanley Black & Decker, and PayPal. Now, these are just a few names of iconic brands that have massively underperformed the market, but could be lending an opportunity here for a long-term investor. Now, the first thing I want to point out is the market does not discriminate, meaning if we are at a top of a market here and we start selling off or getting a correction, most likely all names are going to come down in sympathy with the market. And so as we get a correction in the market and fear starts picking up, the market doesn't discriminate. It's most likely going to be even those names that have sold off so much getting even cheaper. And that's where I think the opportunity comes. And I'm going to rank these because great markets do end with concentration and separation. As I stated, concentration in a few names, separation in the Russell and the equal weighted S&P 500. So let's review how close these stocks are to a buy currently. Now, when I pull up my valuation on Nike, I'm sitting right around a $66 price target, down 30% on the year, paying nearly a 2% dividend and trading at 20 times earnings. This is definitely becoming an interesting name. The problem is the retail factor and the consumer slowing down. Growth prospects going forward. This company has a clean balance sheet. I'm expecting them to start investing heavily in research and development, maybe buying back some stock, and possibly making an interesting acquisition. The clean balance sheet, free cash flow allows them to be really flexible. And so Nike at this point in time is getting into a buy zone for me personally. Ideally, I'd like it to see it in the 60s. Now, arguably a buy right now is going to be PayPal. PayPal to me, if it got anywhere in the $50 to $60 range, I think this is a great area to start buying into PayPal. Once again, very similar to what we think about when we think about Nike. Down 15% on the year, down over 50% over the last 5 years, and over 80% from recent highs. To me, PayPal is in a buy zone here. I definitely think there's some risk here when we talk about payment platforms because it's getting more and more competitive and the margins are going to shrink by the day. As more and more people come to the payment system platforms, it's going to be harder to eke out a gain. But with PayPal's footprint and their focus in one area, this is one that, once again, very similar to Nike, I wouldn't be surprised if we see substantial reinvestment in the business and a possible acquisition. I think a lot of these blue chip, large cap companies that have good balance sheets, good free cash flow, even though sales are dipping here, we're in an interesting part of the economic cycle where there's serious separation going on. It's getting harder and harder to dictate where we need to be looking for opportunities. And so one of the areas we can kind of simplify things is picking companies with phenomenal balance sheets that the market has kind of thrown to the hip side. So valuations are getting pretty compelling, but have the opportunity to acquire companies if we look at possible market dips and downturns in the economy. And I think this is where investors kind of overlook in the short term here on dismissing companies like a PayPal or a possible Nike. Now, Stanley Black & Decker down nearly 16% on the year, down almost 47% over the last 5 years, and from recent highs, down over 63%. Another stock, another well-named brand that has been absolutely hammered. Now, the first thing I want to do with Stanley Black & Decker is just take a quick look at the balance sheet. So Stanley Black & Decker, $449 million on the balance sheet. Total debt sitting at $7.3 billion. It's a little high. Let's see how strong the free cash flow has been over the last couple years. I would say my biggest concern with Stanley Black & Decker is going to be that debt versus free cash flow and the amount of cash that they have on the balance sheet. Don't really love the setup here. Want a stronger balance sheet when I think about possible downturns. And so therefore, PayPal and Nike to me are probably closer to a buy. But if we talk about de-risking a stock and the amount of sell-off that Stanley Black & Decker has, where do I kind of need to buy it here? I think anywhere between $60 to $70 makes sense for Stanley Black & Decker. Could we see another 10 or 12% decline with Stanley Black & Decker? I think the setup is there for them to possibly sell off with the consumer slowing down, housing market kind of in question at this point in time. So this one would be one to kind of put on the back burner and see exactly how cheap it gets. I don't think this is one you need to rush to. I just don't think they're going to have the turnaround story that a Nike or a PayPal could have. Which is now going to lead us to Disney. This one's kind of an interesting one here because many facets to their business, a lot of CapEx goes into Disney. This is always a tough one to really put a price on. Over the last year, they're up around 7%. Over the last 5 years, down 31%. And if we take it from the recent highs, down 49% currently, and was down over 56% at one point in time. And for Disney, I have right around a $75 price target. This is one I did have my wife buy some shares of when it did get into the 70s because, well, this is her favorite company. The issue I have with Disney is the amount of CapEx that they have, and they do have some debt here, but it's debt that's manageable with the amount of cash and how the company free cash flows and how they're growing. Now, of course, if the parks start slowing down here, this could be one that deals with some headwinds. Everything is really based on consumer having money and the consumer willing to spend. So I guess if I had to really rank these from a risk versus reward profile and who I think has a lower floor and a higher ceiling, or who's the safer bet at this point in time, I think PayPal would probably be number one, Nike number two, then it would be Disney, and the reason being is Disney can handle the debt a little bit better, but Stanley Black & Decker and Disney to me are about equal. Now, if Disney was back in the low 80s, high 70s, I would definitely be putting Disney ahead of Stanley Black & Decker. But I think Stanley Black & Decker is about 10 to 12% away from really taking a decent risk here on a solid company, and we know going forward with housing, Stanley Black & Decker is going to be a solid name longer term. It's just dealing with some short headwinds right now. Let me know out of these four, which one is your favorite stock, and we will see you in the next one.